this video, we will take a look at the year-end real estate market and what the experts are predicting the 2024 housing forecast will be. My goal is to be able to provide the most accurate information and actually sit down with a buyer, sit down with a seller, even if virtually through this video, and explain to them the craziness of this market. And I'm going to start with that craziness to 2024 forecast. Hi, this is Tom Olsewski with eXp Realty and Team Olsewski, local realtor here in Southwest Riverside County. Now, if you look up at the top, we have a crystal ball there. The reason we have a crystal ball there is forecasting anything in today's market is really like kind of going to Vegas and rolling the dice. So I'm going to give you the forecast that major entities are doing. This is not my opinion, both on home prices and on the total home sales for 2024. All right, let's start with the prices. We can see they're all over the place. Realtor.com thinks we're going to be down 1.7%. Zillow thinks we're going to be down 0.2%. The other end of the spectrum, Mortgage Bankers Association, thinks we're going to be up 4%. The middle is just under 3%, the Goldman Sachs. I wanted to throw in one of the major banks so that you get a feel for what they're thinking. All right, and that's 1.9%, and ours is 0.7%. If we average all of those together, that's the blue column that you'll see. All of the way to the left, you have 1.5% appreciation. Now, viewers, to be frank with you, the experts are not sure how much appreciation we're going to see next year. Locally in Southwest Riverside County, I'm seeing a lot of buyers who have been sitting on the side who are waiting for interest rates to drop. That could create some pressure. There could be a bunch of buyers getting in the market, and that could push home values locally a little bit higher than that. The experts overall think it's going to be relatively flat, which is closer to normal. They're thinking we're not even going to see normal appreciation, which is 4.92% over the last 40 years. They think we'll be below that. They also think there's a chance we'll half that and be at about 2.5%. All right, that's not bad news, that's good news. We need home price appreciation to slow up a little bit because of the affordability crisis we're in right now. So we need two things. We need home prices, or actually three things. We need home prices to slow up a little bit, wages to increase, and most importantly, mortgage rates to moderate even further lower than they already are, which we'll talk about in a second. As far as total home sales forecasts are concerned, Fannie Mae still has us just below 5 million, and about 5.2 million is what we would be average over the last 10 years. Outside of the what we call the unicorn years, the pandemic years, all right? Because they were definitely unicorn years for the real estate market, all right, we can see that if we average them all together, they're just about 5 million, which will be about a 20% increase over what we did this current year, or 2023. So the forecasts are looking very, very positive. The pricing is saying it's going to be relatively moderate as far as appreciation is concerned, but sales are going to pick up. Now, the reason I would give you the sales second is I want you to understand, I think we have the potential to blow away those numbers. I think that we're coming into a time right now that the market's about to turn in a very, very positive way. And let's give you a couple of reasons why. I think that, well, let's start with mortgage rates. And whenever we're talking about mortgage rates, I want to let you know that was the day we did the slides. The day we did the slides was November 30th, 2023. Because they're so volatile, we want to let you know that by the time you listen to this, mortgage rates might be in a different place. But if we look at it as if it's the end of the month in November, what we can see going all the way from July is there was a slight uptick, and that uptick actually started to increase when we got into September. As we know, we almost hit 8%, all right, on the Fannie Mae. On the Freddie Mac numbers, we actually did hit 8% on the daily numbers. That's interest rates. All right, but on Freddie Mac, we got as high as 7.79%. Then we progressed downward in a good way down to 7.22%. While I'm recording this, which is December 4th, all right, I want you to know that interest rates were at 7.09%. Now, if you remember, I said there's nobody that knows where the mortgage rates are going. No one knows that. But if somebody was holding a gun to my head, this is what I said 2 months ago. I think we would have a shot at hitting the sixes by the end of the year, and that we could get into the fives by the middle of next year, and that's 2024. I then said, but my opinion is not worth any more than anybody else's opinion. And I still believe that, but I do think we do have a shot at 6 by the end of this year or the beginning of next year, and I do think that we have a shot at some 5 number sometime in 2024. If that happens, I think it's going to be very, very active market. Very, very active market because 2 things are going to happen. More inventory is going to come on the market, and we need the inventory desperately. Well-priced inventory desperately. That's a key. The second thing that's going to happen is that the buyers, more and more buyers are going to be eligible to purchase a house. They've all been sitting on the side. We have to remember that every time we sell a listing, like 70% of the time, that also creates a buyer. Because the person selling their house needs to buy a house, and the next house, whether it be a move up, move down, whatever the case may be. So I think it's pretty interesting, and I think that we have some very strong data right now to share with you to say, all right, let's take a look at this and see, is 2024 going to be much more of a breakout year than most people are projecting? Let's start with buyer demand. Buyer demand is actually up over the pre-pandemic years of 2016, 17, 18, and 19. There are more people out there looking at houses. Now, that number's a little bit skewed because there's such a lack of inventory. There might be one person looking at 3 houses where before they might have looked at 1 house and made a decision. So I'm not saying that data is not a little bit skewed, but what I am saying is that it's not in the 90s. There are people out there looking to purchase a home. As a matter of fact, Zillow's latest market report said despite mortgage rates reaching 23-year highs, which is when they were going toward 8, low inventory levels are spurring surprisingly strong competition. Depleted inventory stocks are gradually recovering, and price appreciation is slowing. Both things are good, but demand has remained resilient, and attractive, appropriately priced listings are moving quickly. Viewers, I want you to hear that last part of the sentence again. Attractive, appropriately priced listings are moving quickly. Because I'm going to come back to that later on. Mike Lane, Vice President of Showing Time, who Zillow owns, buyers and sellers remain active in every economic environment, including when mortgage rates are high. Buyers determined to find a home they love will continue visiting homes with their agents. As we mentioned previously, some sellers are reducing prices, which presents an opportunity for those buying. Then, when we're talking about pricing, very obviously, he's talking about list price. There's no evidence, and we'll give you the pricing in a second. There's no evidence that prices are going down. Well, what he's talking about is sellers that have been on the market for a while, and the active inventory that's been on the market 60, 90 days, they're realizing that they're not selling in this market and something has to give. In most cases, what they're doing is they're making the proper adjustments in price. That doesn't mean values are going down. If a house sold for $500,000 across the street, say 6 months ago, and this listing listed their house at $550,000, even though it's the same exact house, same condition, well, it was $50,000 over price. If we now hear that they took a $50,000 price reduction, we think, oh my God, prices are falling. No, they're just bringing that house back to its real value. Understand that there will be people out there that will misunderstand that. That's a big issue. They'll think, and I see this all the time on the internet, they say, listen, this house was priced at this and now it's priced at that. Yeah, well, it was probably mispriced to begin with. So we always want to jump back to your pricing indexes, which again, we'll go over in a second, and see really what's happening with value. Are they going up? Are they going down? Now, the big key is affordability. It's a major, major, major key to us having a really good 2024. But one of the things I want you to understand when they're talking about affordability, because the headlines in the news is a little out of whack. They all like drama. They keep on saying we'd have to increase wages by 63% to reach the affordability of 2 years ago and 2.5 years ago. They say we have to. Mortgage rates would have to drop down to 5% or under 5% to reach the affordability we had 3 years ago. They'll talk about the fact that prices have to drop dramatically in order for us to reach the levels we had 2 years ago as far as affordability. But when we're talking about affordability, viewers, I want you to remember this graph, and I'll show it, because what they're saying is, well, if we go back 2.5 years ago to January 2021, they're right. It's going to take a lot to get that number. But that's one of the lowest numbers in American real estate history when it comes to mortgage payment to income ratio, and that's not realistic. This is the affordability index from NAR, National Association of Realtors, a portion of it where they say, well, how much of your income has to go to a mortgage payment, a medium income, a medium family income, to a medium priced home. If people think we're going to go back to 13.3% or the 11.6% we hit in January 2013, that's unrealistic. Just like they're saying now, it's the highest unaffordability index, meaning it's the worst. Well, the same thing here. We're not going back to the lowest ever. That's not going to happen. We're not going back to norm, and the norm is 25%. We look at the numbers that we see right here. What we can see, viewers, is that we're not that far off. If wages come up a little and mortgage rates adjust, we'll be at 25% mark. We won't be at the 13.3% mark. We might not get back to 13.3% mark in my lifetime. But we're not trying to get the greatest affordability of all time. We're trying to get back to normal affordability. Those are two different things. When we're talking about affordability, the one thing that always irks me a little bit is financial equation that people always use, but very rarely do they talk about the equity buildup, because that's part of the financial equation. Rent versus buy? Well, if you rent, you can get your monthly expense, at least for now, less than if you bought. Maybe not in our area. But what nobody does is they don't put the equity buildup into the financial equation, and I think they should. That's a key part of home ownership. As an example, here's the last 30 years, all right, actually 32 years. The FHFA goes all the way back to 1991. The reason they started in 1991 is because that's when their data starts. And what we can see is anywhere in the country, there's been dramatic appreciation over that 30 years to the point of national average is now over 300%. So when you buy a house, you're right, you might not be able to rent a house with a little less money than you can buy, maybe even a lot less money than you can buy a house right now. But there are a lot of other expenses, and we're talking about a lot of other benefits that we're going to talk about, okay? That's important. So is demand really strong? Well, some people argue that, well, demand's really not that strong. It's just that more people are looking at more houses, less people are looking at more houses, and it's skewing. Well, here are the two things that prove no. Demand is still very, very strong. Here's the average numbers of offers received on the most recent closed sales. And what we can see is, though they're down from the unicorn years, those crazy years of 20 and 21, we're still above the pre-unicorn years, which is good. There are more offers per listings today than there were in 2018 and 2019. And there's more listings, more offers per listing this year than there were even last year. So yes, demand is still strong there. Another indicator that we should take a look at is the median days on the market. Now, people will say, well, let's compare it to 2021. Well, why are you comparing it to the lowest numbers ever? Let's compare it to the pre-pandemic, the normal market, and what we can see is we're selling houses much quicker than we were in the normal market. So yes, demand is there. The question is inventory coming? So let's take a look at the inventory numbers right now. Number one, active listing count is still well below what it was pre-pandemic. So I'm not saying that when I talk about some positiveness as far as listings are concerned, I'm not saying we're back to normal. We have a lot of work to do on the listing side of it. But what I do like is if we look at the black line on the chart, the solid black line going across, that's new listings this year coming out of month to month. The dotted or the dashed line, all right, that line is where normally it would go. If you look at the other years and we go all the way back to 17, we give you 17, 18, 19, 20, 21, 22, this time of year, new listings dive as we're going into the holiday season. That's the last quarter. But this year, that didn't happen. I think that we're seeing, which we saw on the buyer side almost from the beginning, is that the sticker shock of going over 5% on the mortgage rate, then over 6% on the mortgage rate, then over 7% in the mortgage rate, that sticker shock, the buyers got over that pretty quick. Sellers, not so much, mainly because they probably had a mortgage under 4% on their current home, so that makes it tough. But now it appears, and it's several months of this now, it appears that the sellers are starting to get over that sticker shock as well. Whatever need they had to move, they're not waiting anymore. They're starting to bring listings to the market. So if demand is high and listings are starting to come out, now we have some pretty interesting information. As a matter of fact, the week before Thanksgiving, 58,000 new listings came out nationally. In that week, that same week, 10,000 of those listings sold. So I want you to understand that homes are selling. On this graph, you want to be blue, meaning there's more inventory, than there used to be. Year over year, most of the country's blue. Month over month, most of the country's blue. So now what we're seeing is there's more listings coming to the market. If you sell, you will be able to find a home because inventory's been rising. National Association of Realtors 2023 profile of home buyers and sellers came out, and the vast majority of sellers who sold that moved over 100 miles were over the age of 55. So it wasn't the young kids getting a job someplace else in the country, it was more the boomers moving more than 100 miles. And what people always say, is that, yeah, well, that's because they're retired. They went to retirement home. Well, let's take a look at it. The top 5 reasons why sellers sold and moved at least 100 miles. Now, we don't have it broken down by boomers, but those numbers are so out of whack that many of the boomers are in that category. The number 1 reason was not moving due to retirement. As a matter of fact, the want to move closer to friends and family more than double the reason of moving due to retirement. 74% of the people who moved at least 100 miles, that was the situation. Now, the other thing I want you to know that came out of that report is number of weeks it took to sell a house. Now, this is crucially important that you understand the graph, because what this graph is telling us, if you didn't sell in the first month, the chances of you selling aren't good. What does that go back to? The home will need a price adjustment. Can't get aggressive with the price based on your condition. Now let's go to home prices. We talked about demand. We talk about inventory. Well, how is that all going to affect prices? I broke down this year so far the latest available information through any of the repeat sale indexes because they take time to process all of it in September. What we've seen very easily is that prices have remained pretty much even in each one of the indexes, showing what? Every month prices have gone up. Outside of January, every month prices have gone up. So this fear that prices are going to fall is not real, and don't be waiting for that. However, I want you to understand that we're not making a dent in the number of people that think prices are still going to fall in the next 12 months. 23% of consumers, based on a Fannie Mae poll, think the prices are going to fall over the next, depreciate in the next 12 months. Now, the good news is that's down from 37% in January, but the norm over the years, that number was like 12 to 14%. So there's still a lot of people, 1 out of 4, still believe prices will depreciate just about, and we're going to have to make sure that we're in front of those people, and that's the purpose of this video, so we can let you know the graph and the data I just gave you and the graph I'm about to give you so that you understand what's happening with prices. Appreciation's going to slow. It's going to slow this time of year, and it's going to remain soft next year. That's 2024. That's not a bad thing if they have. This is what I promise you, that graph I showed you, or that chart, that map I showed you showing that on average it went up 300% over 30 years prices. Over the next 30 years it's going to do the same thing, but we're not going to have a strong year next year, and that's 2024. That's the point I'm making to you. Now, as things are softer, there are going to be some headlines explaining, well, prices are falling, and they're not. This is what people are confused about. The facts don't lie. This is the normal 49-year average. I've given this to you a couple of months ago. at the 49-year average. How much monthly prices increase? Now this is non-seasonally adjusted, which is a little bit different than the other graph I showed you. Most people report seasonally adjusted because year over year or month over month, so we can see that. But when we go back 49 years, we want to say, well, actually, how much does a house go up every single month? What we can see here is during the spring, prices go up as buyers come out and there's a lot of excitement about buying a house. Prices appreciation rises. It accelerates at that time of the year. Then starting in the summer, it starts to deaccelerate through the rest of the year. Now, the last couple of years, you could throw this out because prices were all over the place. It wasn't normal. That's why we call them the unicorn years. It wasn't normal. But this year now, I'm taking this slide, minimizing it, and putting it against the price appreciation this year. What do we see? It started out slower than we normally would, because remember, the last year, the last couple of months, we actually had depreciation because we had so much excess appreciation in the first half of the year. But what's taking place right now, we're going back to normal month over month appreciation. We're going back to the 49-year average. So that's good news. We don't have skyrocketing appreciation. If we did, the affordability chart would just fall through the bottom of the floor. We're going back to normal appreciation. That's a good thing. Now, because it's less per month, meaning the appreciation is deaccelerating, what are some headlines going to say? To people who don't understand, they're going to say, prices are falling, prices are falling. No, they're not. They're rising at a slower pace. There's no red bars. They're just rising at a slower pace. Where are we going to finish this year out? And we're probably close to the end of the year. This is what the projections are that we're going to finish out. And I'll have a chart on that. Now, we'll know in another 6 weeks, 7 weeks exactly where we finish out the year. But it's kind of strange that there's such a disparity, especially with NAR. Now, the only thing with NAR, one thing I have to give them credit for is they do it quarterly. So the next quarter might jump up dramatically. But what we're seeing is we're going to be like normal appreciation. So what did I tell you was normal appreciation? 4.92%. If we average out these 6 price forecasts, where are we at? 4.6%. So this year is going to be a normal year in price appreciation. Next year may be a little bit slower than that. What does that all mean to you? And that varies from area to area. It's vitally important that you understand that because the market is opening up, mortgage rates are falling, not skyrocketing. Inventory is starting to come back on the market. Buyers are still very much in desire of home ownership, which is great if you are thinking about selling. So we have a tremendous, it's just like we had a perfect storm real estate-wise, that everything went wrong in the middle of 2022. I think we have a perfect storm now where everything's going to go right at the beginning of 2024. Well, I want to end with this, exactly what I started with. There are forecasts. You have them in the first couple of slides that I've shown in the video. Locally, I think we're going to blow some of those numbers away. Not so much the pricing numbers. It could be, though. I think the pricing is going to remain relatively modest. All right. Depreciation is going to be relatively modest, if at all. But the sales numbers, mortgage rates are going down. People are coming out. People are starting to list. Buyers still have strong demand. I think we can do some great numbers on the sales side. I think there's a pent-up demand that's about to be released in the market this spring. So you may want to take advantage of that. I will have another video with local year-end numbers coming out soon. So subscribe if you haven't done that yet. Excuse me, that's it for now. Thanks for watching. And if you have any questions, please feel free to reach out to me directly. My contact information will be at the end of the video. Thanks for watching.